Hey traders, Raghi here, and while I'm recording this video, I realize I really don't have a title yet for it, but I'm leaning towards fear-mongering, right? Or I'm leaning towards, are the bears right? And first of all, fear-mongering, I hate it. That's what television does to keep you tuned in so you watch the advertisers. That's what folks do to convince you to let them manage your money as if they care more for your money than you do. I love the self-directed retail trader. I'm one of them. I have been for over 30 years. This is why I do what I do, so we can collectively help each other navigate the markets. So when I hear people fear-mongering and talking in hyperbole about how low the markets are going to go, I look at this weekly chart, and I'm going to give you sort of a map based on data and price that hopefully resonates and gives you a chance to look through all that noise and say, okay, this is what we're really dealing with, and why. This is the weekly S&P. Please take a really good look at this for a moment. Okay, this includes the sell-off in early 2020. All right, and I also have the V-score on here, and I want to show you something. Other than that big move in 2020, and everyone knows what that was, right? That's the COVID low, which I keep hearing. That's where we're heading. That's one of the more stupidly hyperbole type, projections I'm hearing right now. But it's out there. We have yet to, on a volume-weighted average price, even get through the mean since that time. That was a dramatic move, no doubt. We got back above the mean, and we have stayed above the mean since summer of 2020. So I'm going to give you a little bit of perspective. We've tested that area a couple times. We did so at the end of June. We might do so again here in September, right? Maybe it's October. But notice that we have spent no time since basically, May of 2020 below the mean on the VWAP. All right. We have spent we've spent no time below the 200 exponential on the weekly either. So I'm supposed to believe that somehow between now and 2023, that this market's going to go down to 3,000, maybe 3,500. I don't know what the number is, but pick any of those really crazy number targets that you're hearing out there and just ask yourself what's going to get us down there. I look at S&P and I think the next time we go to the 200, or the next time we revert to the mean on the V-score on the weekly chart, I'm a buyer. Okay, let's take a look at the daily and kind of see why everyone's all worked up. The last time we had a big sell-off was Jerome Powell, macroeconomic catalyst. Jerome Powell was actually talking about monetary policy and a more hawkish tone. Today, CPI. Look at that reaction to CPI. When you look at the CPI number, let's say you run back on over to Forex Factory, and you look at the CPI data today that came out, it was an expectation for a downtick, a negative 0.1. We came in at 0.1, right? We expected a core CPI. Core always means we're excluding something, by the way. Core anything means something's taken out. In this case, food and energy. Because, right, who cares about inflation of food and energy, right? No one needs that. So you realize the core number is something that economists and talking heads will talk about. But you and I, we live in the CPI. We don't live in the core CPI. Last time I checked, we all need energy. And I'm pretty sure we're not fasting for 6 months, right? We all need food. So that CPI really, for all intents and purposes, was a 0.2 miss. And this was a result of that? Not entirely. Let me show you how to measure what happened today. And then now, once you understand what happened today, you can have a much clearer picture of why I'm still bullish. Not that we're just going to bounce and up and away in an uptrend, but I'm not going to call for, 3,000 S&P or those other type fear-mongering targets, okay? When I was 15, and I'm going to tell you why I hate the fear-mongering so much and why I want to empower you to at least see the markets the way I do, use what is valuable. dismiss what you're not convinced of, but at least let's have this conversation. When my mom was 40 and I had just turned 15, I think I was maybe 2 months past my 15th birthday, my father passed. And my mom had, she had some money. She's a widow, but she had some money. A little bit, not a lot. But boy, everyone just descended on her, and they wanted to separate my mother, who was still heartbroken and scared out of her mind with a 15 and a 13-year-old, from her money, as if they cared more about her money and her children and her future. They cared more, right, than she did. Come on, right? We know that's not true, but they scared the heck out of her. Why did they scare her? Because they wanted to manage her money, because they made a management fee. And 15-year-old Raghi started watching and learning and listening. And my 40-year-old mother decided, the beep with you all, I can teach myself how to do this. If you can do it, I can do it. She started reading, she started studying, and she actually became a heck of a market timer. If you want to know where I started developing my trading chops and my love of the market, it was watching my mother use the market to establish some financial stability for her, my little sister, and myself. So I'm really passionate about this, and I get furious when I hear people fear-mongering retail traders and investors. Okay, I'll get that out of the way. So I at least want you to know where I'm coming from. Take a look at the September target rate probability. This is where the rubber meets the road. CPI comes out. Remember, we missed this thing by 0.2. This was the drama? Well, what that means is inflation was running hotter than anticipated, than expected, and we now think, via trading the Fed Fund futures, that we are definitely going to see a 3/4 point hike. We could also see a full point hike. The 3/4 point hike is the most probable. The 1 point hike is possible. So don't let anyone say, we're going to hike a point. No, it's 34% possible, while the 3/4 of a point hike is most probable. Now, these can change throughout the day to day. Right? These can change. And they're going to change every time Powell opens his mouth. They're going to change every time we get data like today's CPI and even tomorrow's PPI. Right? But this is what is most likely. What this did, the domino started to fall. It pushed, and this is why the market sold off. Okay, gang? It pushed the target rate probability expectation for December from 3 3/4 to 4% to 4 to 4.25%. That's probable. What was next possible is all the way up to 4.25 to 4.5%. Please know that is a full percentage point higher, or a full, from 325 to 350, which is where we were most of the year, now to 425 to 450. That's a lot higher than we thought we were going to be for half the year. If you go into early August, we collectively, using Fed Fund futures and this target rate probability, we collectively, as traders and investors, were looking at 3.25 to 3.5%. Now it's 4 to 4.25, and possibly 4.25 to 4.5. Yes, equities are going to hate this, and that's what got discounted. All right, we wake up tomorrow, PPI. Maybe it's not as bad, meaning it's showing inflation is in check, or maybe it has another CPI reaction. But the equity markets are really not responding to the PPI. They're responding to, what are these two columns going to do? They're responding to what September and these two columns are going to do. So take a look at these columns. You can Google CME FedWatch tool. It'll bring you right to this page. Click on September. See what these are at, say, 8:25 a.m. Eastern, and see what they are at 8:31. And then see what they are at 9 o'clock again. And just progressively watch the shift in these columns. That's what's going to tell you whether or not stocks are going to sell off or rally. That 210 CPI, who on earth would think we would have the largest sell-off since the Jackson Hole shocker because of a 0.2 miss in CPI? That's not what the reaction was to. The reaction was to a higher December rate, and I'm not done yet, and even another quarter to maybe half point by the time we get to March of next year. So we're not going to peak and plateau in December. Traders have collectively decided. They now think the Federal Reserve is going to continue to hike into next year. February, probably. March, well, I should say February possibly, March possibly. Look how low right now. I mean, all of these are pretty much kind of not that different. There's no one column that's, way out in front leading the charge the way we see in September, right? So it's still up in the air. But again, there is a quarter point hike possible in February and possible in March. Keep that in mind. This is why the stock sold off. This is why stock sold off, period. That's it. Macroeconomic policy, if more hawkish, sends stocks lower. Let me tie this up to what we know now. This low in June, maybe on the heels of some recession conversation, which, by the way, was quickly shrugged off. So do we care about recession? Gang, we really don't. And then you take a look at Jackson Hole, and you take a look at this now. We are expecting, at minimum, a half point more hikes than we even thought of in June, and yet we're nowhere near those June lows. All right? We've gone through Powell ratcheting up the hawkish talk, and now today, definitely factoring in a far higher target rate probability come December, and we're not even trading at the September lows. So my thought is, well, why would I presume we're going to make brand new lows? Why are we going to keep heading lower? So the answer is simple. We won't, as long as this does not look that much different after September 21. After September 21. That's the FOMC meeting. If these columns don't look that much dramatically different, meaning our target rate probabilities aren't suddenly surging to 4.5 to 4 3/4 or 4 3/4 to 5%, as long as that's not the direction these columns are growing in, no reason to expect dramatically lower lows. If they do, well, then of course the equity markets are going to continue to sell off. But think about what equities have already absorbed. And then ask yourself, what's it going to take to really make significantly lower lows? Maybe we do test 3,600. Maybe, but what's that going to take? We're already seeing companies guiding lower for the next earnings season, so that's slowly being discounted. That's a conversation that's being had, and if it's a conversation being had, it's being discounted. All right? So please keep that in mind. And then when you take a look at yields, right, that's going to, bonds, the long bond, the 10-year note, and our Fed fund futures are going to roughly do about the same thing in terms of reacting with higher expectations for higher yields. We haven't actually made a lower low on the 30-year bond yet. We're testing it. Don't get me wrong. And if this had not been a double red downtrend, I would actually think about, and I still might, think about a very aggro, small, minor low buy. We're right at that Darvas low. We didn't punch down to lower lows, gang, which means we did not punch up to significantly higher yields on the long bond. Here's the 10-year. We're not even close to it. We are not seeing higher yields than we did back in June in the 10-year. Keep that in mind, because the punchline always is, gang, what's new, right? What's new in terms of macro data or headlines or whatever, but macro data is my focus. And has that new piece of information carried price somewhere new? And then my question is, what's it going to take? I really didn't intend to make this a really long video, but I guess you can probably hear I'm kind of worked up because I'm tired of the forces out there trying to scare the heck out of you. Because I remember as a 15-year-old kid watching my 40-year-old mother, people try to do that to her. She empowered herself, right? And I swore to myself back then, if I'm going to learn how to do this, I want to be the person that my mom would have gotten help from. I want to be that person that could have helped my mom at that time. And I hope this at least gives you another perspective in a measurable way, not my gut, not what I think, not hyperbole, but showing you data, showing you dates, and seeing if that resonates. Gang, if you have questions, leave them in the comments. Raghi, don't have ranty 15-minute videos is perfectly fine too. But I hope this helps. I sincerely hope this reaches some folks. And there's no reason to be that pessimistic. Because remember, gang, go back to the weekly. If you're worried about your investments, remember, this isn't about today or this month. If you look at your investments, you're looking at a minimum 6 month to 1 year time horizon. The ebb and flow in 6 months in a year, that's nothing that you have to be concerned about. Not by my opinion. This is not something you need to be concerned about. This is the market since 2019. This is where we are right now. That weekly candle holds that crazy CPI candle. The one before it holds Jerome Powell's candle. Or the one before that holds that crazy Jackson Hole candle. We're not even at the 200 on the weekly. So please don't let people scare you into thinking we're circling the drain, that the sky is falling, right? Not right now and not yet. So I've given you some scenarios for which way we could go. I hope that was helpful. I'll see you in the next update. Hey traders, Raghi from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.